All right. So we're going to start off and just talk about what is Palantir, what do they do, what is their business model, their competitive advantage, and stuff like that. Because I think a lot of people have a hard time understanding what it is they actually do, and I think that's why, to a lot of Wall Street and bigger investors, it's just thrown into the too complicated pile and not enough history pile, right? And that's why it's seen as more of a speculative investment. Um, so the thing is I believe that data is the new oil. We have so much collection of data in so many different areas of our businesses, and the more we know about what's going right and what's going wrong in our business, uh, allows us to make better decisions to grow our business and give ourselves a competitive advantage. So this is what Palantir does for companies. Is you have so many different systems. Like I've ran my own business in the past, and it's like, I have my CRM, and then I have my email, and the CRM isn't connected exactly to the email perfectly. And then you have phone calls that you're making to people, and you have advertising campaigns on Facebook and Google, and you have all of these different things going on, and all of this data. And the thing is none of these different devices and apps and things that you use in your business, is they don't talk to each other. And there's no way to take data from all of these different things and put it into one easy to read format, right? Does everyone follow?
Yeah, totally.
So this is going to be, in my opinion, like, think of how Windows is. Windows is an operating system that has all of these different apps and different things that you use, right? But Palantir's version of Windows is basically allows all of those things to communicate with each other and takes data from all of it and uses AI to help inform you to make good decisions. Okay. So
So, just a quick question. So does that mean we can think of it as an actual operating system for enterprise?
yes,
And then you need to train everyone to use it.
yes, and they've already started expanding into the developer community in the same way that like Amazon Web Services did in in terms of getting all of these developers to build their applications on it, right? They've started to do a lot of this, and they've started to have, like, I know there's like Amazon Web Services certified technicians or developers, and they've started that within Palantir as well. So getting to the developers and allowing all of these different developers to build their applications on this Foundry system. Um, so yeah, it's it's hard to explain, but like what happens is the so have you guys read Peter Thiel's book Zero to One?
No.
No.
No? Okay, so what he talked about, and what this is probably the best way, is how he probably got the idea for this. So when they were running PayPal, is they had to try and weed out the fraudsters. So they developed algorithms and sort of like an early AI back in the day to um, flag and stop transactions that might be fraudulent, right? Now, the problem with this is that when you have a computer system and an algorithm doing this, very quickly the fraudsters would catch on, and they would know what they're doing that gets flagged, and then the fraudsters would change their behaviors. So the idea that they had come up with is, how can we take the automated data algorithms and AI to sort through thousands and thousands and thousands and thousands of transactions each day, right? And then what would happen is they need a person on the other end to be able to give it a final review. So what would happen, what they ended up doing, is they would have the computer system scan all of the transactions and look for all these certain data points, and it would flag them for a real person to do, because a real person would not be capable of looking at that much data. It's impossible for a person to do it. So what the program does is it looks through all the data and then shows you what's relevant to you. Okay. And what makes this so complicated and such a competitive advantage is what is data? Like, what does each data point actually mean? So when you have all of these different data points from all of these different systems, what are these data points and what do they mean in the real world? Like, how does this actually mean anything? So what their system is able to do, and it's able to look at all of the different data points from all these different systems, identify what they are, what is this piece of data, what does it represent, and then how is this data relevant? So it basically creates like a virtual, it takes all of your business and creates a virtual version of it, right? So when you have sometimes, especially with bigger businesses, let's say if you have 5 warehouses in different cities, you have all these different truckers going to all these different sites, you have deliveries, you have inbound stuff, you have outbound stuff, you have storage, you have all of these different moving parts. This identifies all of those pieces of data, brings it all together, and is able to help you make decisions. So a lot of times decisions that the human is making on the other side have second and third order consequences, right? Like if I send out this product today, then we don't have enough for this next order next week. So what does this mean for the other orders and the other shipments? And it's identifying what does this data mean and running.
Quiet question, and I apologize if I missed, maybe it may have missed bits of the talk because my internet connection wasn't stable. So what you describe is, so one part, it could be seen as a data visualization sense making tool, right?
Yes.
To allow individuals, even if the employee is not a data scientist, is not a programmer, to see quickly trends and possibly causal relationships.
Yes.
But is there a part of the, so anyway, so like, I guess we're talking about Foundry at this point, and Gotham is the government platform, right? So
Yeah.
we can think of them as separate Windows
they
operating systems.
They are separate, but
yeah.
the idea and the way it operates is very similar.
Right. Okay. So in terms of the AI, what is the learning aspect? If you think about like this artificial intelligence, this is, you know, you let it train on the data, right? And there's different ways of to train the program. Is Palantir developing something like a neural net, or is this a isolated? So it's kind of like for each organization, they will have their own AI training. You know, like I don't, you know, like I'm not an expert, so trying to put into terms that I understand.
Okay, so what is that's what we're going to get into next with the business model on like how it's going to expand. But so what the AI does is it learns what all this data is, how it's relevant, and then it can run thousands and thousands of different simulations, right, to help you determine what to do next.
So I have a couple thoughts here. The first one is just, I'm totally sold on the idea of data. Just people might not know it's about me watching, but like, I'm a bit of an amateur statistician in the sense that I like spend most of my free time reading and researching about stats. I have 2 blogs on the topic. I wrote a book on the topic, and I invest based on statistics. But the average person doesn't understand statistics. And then, so I have 2 big concerns. One, so in statistics, we use certain calculations and models to determine the relevancy of trends and patterns that we see, because just because we see a trend and pattern doesn't actually mean it's relevant. Sometimes trends and patterns are actually caused by random variability in the data. We use all these calculations to figure out, is that what we're seeing a real trend, or is it variability? So then my question is, does the program use these calculations? And then the average person wouldn't understand those calculations. So does it then like spit it back out into terms that people understand, or does it just show like baseline trends?
That's exactly what it is. So it's all customizable to the business. And basically everything that you do. So like, let's say here's a perfect example, I think you understand. So when you're doing your research on whatever data set you're looking for, right, you probably have to go to how many different sources to find data?
Dozens.
Dozens.
I spend so much time manually entering data. It's like the hardest part.
So what would happen if you had something that can go to those dozens and interpret all of that data and bring it to you in one source on one screen?
Oh, it would make my life a lot easier. I'd be a lot quicker.
That is exactly what the software does.
That's cool.
For
so
businesses.
my next kind of question here and sort of bearish concern is two-part actually. One, I find that people aren't that interested in this type of technology. I think this is the most like data collection and analyzation, in my opinion, is one of the most valuable tools we have in the modern society, because so much of what we see in life we think is subjective, but we can actually find objective answers to it.
Yeah.
Which is why I'm interested in data collection. But most people don't care. As someone who like spends their day reading and writing about data, and then puts it up on the internet, like the audience for that information is pretty niche in my opinion and experience. So my question is, how does the business convince people that this actually means something for them and that their gut feelings aren't more important than this data? Because that's what the average person thinks.
Well, it's not.
It's
not consumers.
It's not consumer. This is B2B.
Yeah, but just because the business isn't your average consumer doesn't mean the business also doesn't think like the average person. I think businesses are run by people, right?
I think businesses are starting to come on and see the way data can help them. So I'm gonna pull up and share my screen right now, and we're gonna talk about exactly that. So,
well, Nate, yeah, I mean, while Tom's doing that, seems like your concerns are, well, okay, how we're gonna, so you recognize the value of this program, but you see a difficulty setting it because whoever who's making this decision may not be receptive to these benefits. But
yeah,
considering it's B2B, wouldn't they sell to someone who's like I don't know, like
so a lot of their
officer or something like that who understand these?
So can you see my screen?
Yeah, we can see it.
So they have a few ways to that they're going about gaining customers. So they just hired a sales team, right? And then on the reverse side, what they're doing is they're trying to get into the developer community and get the developers on board, because then the developers that work for these companies internally will want to get the company to onboard this process, because it's going to make their lives a lot better, right?
That makes a lot of sense. That's a good model. I like that.
So here's where like a lot of people say, like, why are they losing money and stuff like that. So their business model and their sales process is broken down into a few different cycles, right? And they're, because of the complexity of the software, it is a little bit longer of a sales process, right? It's not like, so a lot of other companies, and what separates Palantir is that other companies have a specific product that they sell. Like, let's say, if I have a CRM, and then it does all of the things that a CRM does, and I sell that to all of these different companies, and it's like a one size fits all, right? So what Palantir does in their first phase is what they call the acquire phase. So this is right now, I've just got I think this is their it's found on their quarterly report. Okay. So it says, we actively pursue discussions with existing and prospective customers in order to identify ways in which our software platforms can provide long-term value. In the first phase, we typically acquire new opportunities with minimal risk to our customers through short-term pilot deployments of our software and platforms at low or no cost to them. We believe that providing the value of our platforms to our customers during these short-term pilots, we operate the accounts at a loss. And we believe that our investment during this phase will drive future revenue growth. So their sales pitch is, hey, let us come in and identify the problems in your business and show you our software and let you use it. And once we can prove that we've added enough value to your bottom line, then we can start to talk about how much we're going to charge you.
So would it be fair to say that right now they have a functional monopoly?
Definitely on the government.
So, this is one of my biggest concerns with Palantir, though, is it's just the future competition. Because from what you've told me, it doesn't seem like they have a lot of competition right now. But there's so many companies that are working on AI right now, and one of the ones I see that's really quietly behind the scenes pouring a ton of research and money into AI development is Google.
Yeah.
And like, as far as I'm concerned, like Google is probably the best company in the world. Not from necessarily a should you buy it right now perspective, but from like the qualitative side of the business.
Yeah.
They're just such a powerful company. They have so much money, so much capital, so much resources.
Yeah.
Like I see Palantir as potentially competing with Google, and I see that as a problem for them.
So we'll get into the competitive advantage and how they're going to get that competitive advantage. So
yeah, I have a question on this as well, right? So you mentioned Salesforce, and actually I thought that was the closest. You know, if you want to use an analogy to understand Palantir, it's like we're going to understand Salesforce. You know, I read a book called Capitalism in the 21st Century, Capitalism Without Capital. Actually, its name is Capitalism Without Capital, but it's there's a subtitle. But the authors basically are a bunch of economists that they argue, well, look, you know, the new way companies compete is through these intangible assets. And one of the key benefits, as well as the risk, right, is the intangible assets can scale sometimes infinitely at little cost, right? So
Yeah.
when you say, hey, you know, like with these companies are pushing their products because they're all trying to get the dominant position, you know, whether it's Microsoft, whether it's CRM, because they can leverage their existing product, make minimal changes, and then try to get the customers to pay, and then they have the subscription model.
yeah.
But with Palantir, you have to do a lot of modifications because you said like they don't have, you know, they're not in the business selling apps. They try to sell the operating system, and then they have to tie all the bits and pieces of the business company's kind of communication system into their own. I'm just then
but the software does all that through AI.
Question of like, yeah, how scalable this truly is.
So what they say is what used to take months to onboard can now be done in days, because actually, before we get into the sales cycle, I'm going to address what you said, Nate, about Google and competing with Google. So Google has a lot of money to sink into a competitive product to face Palantir, right?
Basically infinite, really.
And you know who else has? So what a lot of people don't understand is the US government has been sinking money into this company for 18 years, right? So like the amount of money that the US government has and the resources and spending in R&D to create the absolutely best product, I think might be a little bit above Google.
No, that's a fair point. I hadn't thought of that. I didn't realize that.
So
the fact that they've been spending money on creating this product for 18 years and it's still not making a profit.
Here's to address that is the company is 18 years old on the government side, but on the commercial side, they're only a few years in, right? So before it was 100% government revenue, and all of the development of the projects was all funded by the government. So we don't have the last 18 years of financials, but like the CIA is funding this. So like you see that stuff that like when you see on James Bond, how they have all of these different things, like it's like that, right? Like
yeah, the commercial side I think is growing a little bit faster than the government side right now.
Yeah. So what they're doing is they're taking all of the knowledge that they built for the U.S. government and putting a commercial application on it, right? So, and a lot of these government contracts, like they have different like CIAs and like all of these like black ops and like different stuff that they're not even allowed to talk about, right? So the technology that they built for what like they said in the conference call, they basically said like they built Skynet. That's what they have.
See, from someone who likes, so personally, I try to avoid companies where I see significant ethical risk.
Yeah,
it's not to mean this. I think it's challenging to invest 100% from an ethical perspective, but I do try to hold out anything that might have ties to military or oil and gas for the most part. So that to me actually is like an ESG concern, the fact that they have ties to the United States military.
Yeah. So, but that addresses a little bit more of your versus Google.
That's a really good point about how do they compete with Google. That's fair.
Yeah. And now, so what they do is they go into the business and they basically give them a free trial, right? And then once they are through that phase, so it says we define a customer or potential customer in the acquire phase at the end of the calendar year if we have recognized less than 100,000 in revenue from the customer in that year. It says we evaluate the success of customer accounts in the acquire phase based on the revenue such accounts generate in the following year. In 2020, we generated 0.3 million in revenue from customers in the acquire phase, which yielded a contribution loss of 36 million. So they had a group of customers that they had generated $0.3 million and they had spent on this 36 million, right? Now in the following year, those same customers generated 15 million in revenue, which yielded a contribution loss of 7.1 million. So for the first couple years of the business relationship with new customers, they lose money, right? And what they're focusing on is the lifetime value of that customer. So what's going to happen is in the acquire phase, they lose money. And now, so over that cohort, they lost first year, 36 million loss, second year, 15 million. Those same customers generated 15 million. So they went from a 36 million loss to a 7.1 million loss. Now then they go into the expand phase, right? So our investment in the second phase is significant as we seek to understand the principal challenges faced by our customers and ensure that our software delivers and values results. Now, we define a customer if we have recognized more than 100,000 in revenue in the calendar year and had a negative contribution margin during that year. So if the company has had a negative contribution, so they're losing money, then they're in the expand phase. In this phase, we operate at a loss as measured by contribution margin in order to drive future revenue growth and margin expansion. In 2020, we generated 20 million in revenue from customers in the expand phase, and with a contribution margin of negative 159%. In the 9 months ended September 30th, those same customers generated 62 million in revenue with a positive contribution margin of 45%. So yeah.
Yeah, I mean, it's just seems like they're playing an extremely long game, which is fine. With that though, you better see a churn of close to zero. Is it actually at zero?
I got to check on the exact numbers, but like I don't want to get distracted. Let's get through. We can get to the turn after. So yeah, they're playing the long game, right? Now they go from a $7 million loss, and now the revenue's growing and the margins are expanding. So now they're getting a 45% margin. Now they're going into they go into the scale phase. So as customer accounts mature, our investments and costs relative to revenues generally decrease. So once they have you in their system and your company's on their system, it costs them almost nothing to service you.
Yeah.
Right.
Also, I think I noticed one thing, right? It's deceptive if you just look at the contribution margin, because what they're earning positive margins are on a much higher base, right? Because as I think that customer relationship matures, the customers start spending more. As you can see, well, at the beginning it was like 20 million, right? And they have negative margin. Then it became 62 million and positive margin. And just comparing the percentages, I think it's misleading because those 45% counts for way more.
Yeah. But like these are just like some, just to understand how they get people into the system.
Yeah.
Right. But I definitely agree that, sometimes it's better to compare apples to apples. But like, I wish that you could look at like all their detailed stuff, not just what they put in these reports. But it says now once they're in the scale phase, we define a customer in a scale phase if we've recognized more than 100,000 in revenue and those that had a positive contribution margin at the end of the year. In the scale phase, our partnerships with customers, we generally see a contribution margin on particular accounts improve. We generated 1.1 billion in revenue from customers in the scale phase with a contribution margin of 63%. In the 9 months ended, those same customers generated 993.4 in revenue with a contribution margin of 64.
So is that, but it sounds like their cost of revenue is quite high.
No, they have a gross margin of like 80 something percent.
Okay.
But we're gonna get into the financials after. We're definitely not gonna skip the financials.
I'm just sitting here excited for the financials part.
Yeah. So like right now we're just trying to understand the business model and how they're going to operate, right?
So what is when they say contribution margin, what is the variable cost?
So we'll go into, here's what they have listed as contribution.
Yeah.
So it says, we believe that revenue we generate relative to its costs we incur in order to generate such revenue is an important measure of the efficiency of our business. We define contribution margin as revenue less our cost of revenue and sales and marketing expenses, excluding stock-based compensation divided by revenue. At the end of each year, we categorize each customer account into one of the three phases.
That's interesting. Usually companies do not include sales and marketing expenses as part of the contribution margin. At least the way I teach accounting, it's mostly if it's a service business, it's the cost of the labor. If it's a manufacturing, then you have raw materials, labor, and overhead, right? Usually sales and marketing.
But the sales and marketing would be sort of like, because they're the way they go into a business and sort of give a free trial and are sinking money into it. That's, I think, could be part of the sales and marketing, right?
And the cost of revenue would be the employees they send to a particular project. Is that too simplistic?
I think that would probably be fair to say.
All right.
Yeah, and if we go further, it says revenue is allocated to each customer account directly. The cost of revenue, sales, and marketing costs include both the costs associated with the deployment and operation of our software, as well as expense associated with identifying new customers and expanding partnerships with existing ones. Our software engineers work with existing customers, often to manage deployment and operation of our platforms, as well as identify new ways those platforms can be used.
Right. So just we're getting knee deep into the accounting, which is fine for me, but just to zoom out a little bit, when we say data is the new oil, I heard this criticism levied at Palantir is that they actually don't own the data, right? The customer owns the data.
Yeah.
So they provide the operating system. So what is more valuable? Is it the data or is it the operating system?
It's the operating system, because what good is all this data if you don't know what to do with it? If you can't get intelligent insights from the data, right? So what Palantir
Well, what's
said,
more replaceable?
I actually agree with Tom here. And just to give the background, I've spent most of the last 2 weeks just reading through data and analyzing it. But the average person doesn't have the skills required to analyze data.
The average company.
The average company. And even I'm not professionally trained in this. I'm like amateur, but I still spend a large amount of my time reading academic papers that are data-based and then going through results. And oftentimes I see people with PhDs doing inappropriate calculations in statistical analysis, and I redo those calculations because they're wrong. So the fact that people with PhDs make mistakes on this type of thing just tells me that it's a really complicated process, and it is, as Tom pointed out, it is really manually intensive labor to go through data and try and figure it out manually. So Palantir can do this in a way that is both effective and time efficient. I think it's really valuable.
Especially
I think the real question is the marketability of it. It sounds like they're putting so much energy into trying to build a client base, and then I kind of worry about at the same time they're doing this, there's other really huge companies like Google who are developing their own AI softwares. They're going to be trying to swoop in, who have better brand recognition. And then it's also, I feel like it's going to be a really competitive space in the future, because I think there'll almost be an arms race between companies as we see that there's more value in this type of product over time.
Right. So this comes back to the replaceability issue, right? That's how hard would the customer find this? Well, Google is charging us less now. Thanks for all the work you've done for us.
Yes, exactly. That's my point.
So when we get into their moat and what they're creating now to stop competition in the future, is basically what they're trying to do, and what I see them doing is they become the industry standard. So like, for example, when you infect an industry, right? Like what they're doing to the airline is like they got Airbus as a customer, and now Airbus found their products so useful, right? That Airbus said, hey, let me pay for the product for all of our customers, right? And then what happens is now when Airbus is using it, now what happens is all of their suppliers and all of the other businesses that they do business with, like the parts suppliers, the shipping companies, it infects into all of those other companies. So when you have like the network effects of like Metcalfe's law, when an entire industry gets affected, when all of the smaller companies that do business with it, so they start off with Airbus, then they go into like the air traffic control, and they go into all of the different airlines and analyzing all the different airlines data, right? And now all of the different parts, mechanics, and it spreads because
They're the Borg, is what you're saying.
pardon?
They are the Borg, is what you're saying.
Yes. So like the way I've tried to like say it is that in Peter Thiel's book, he sort of says that I just lost my train of thought for a second.
Okay.
Yeah. So like,
what's Thiel's the role with the company?
he's one of the founders and initial investors. So,
Okay, that's fine, but I get that he's.
I don't think he plays a like a direct role in operations. Just like as a board member.
Oh, he's on
the board.
a non-executive board position, I guess.
Yeah.
Right. So I guess I see the appeal of that marketing strategy, right? You go after the head honcho,
Yeah.
right, and then that has a cascading effect on the rest of the economy, as you suggested. Customers and suppliers who doesn't have the scale as Airbus. Which kind of defeats some of the bear arguments that, this is only marketable to the biggest companies in the world because only these companies can afford it. But you're saying that's not true. It's basically it's their choice to go after these big companies.
No,
they have a leadership position in their industries.
But see, Airbus found it so valuable that they're like, all of these other companies that purchase off us, we're going to pay for it for them.
Wow. That's pretty cool. I actually don't think my biggest bear case is not the competition, although I do think that's a problem for them. My biggest bear case is actually the valuation.
Yeah, we're going to get to the valuation too.
Cool.
So what they did with the airline industry, they're about to do in the shipping industry. So they just signed a deal with Hyundai Heavy Industries or whatever. So like all of the big major ships and stuff like that.
I mean the builders, or am I mistaken? Because they're like they're transport companies like Maersk, right?
Yeah.
And then you have the builders.
Yeah, but they're like a conglomerate that like Hyundai is like a conglomerate that owns like billions of businesses in all different parts of the supply chain and everything like that.
Okay.
Right.
That makes a lot of sense. I was going to ask you about that because the predicted profits for next year compared to what they are this year are like off the charts. So I thought there must be some kind of big contract that's coming up.
Like that one is just started. Is what we're projecting is the expansion of margins. So because they have all of these customers, because they've only been in the commercial side for a few years, right? So because of the length of their sales cycle, I expect over the next, let's say 5 to 10 years, a lot of these customers to grow into the parts where they're not losing money, right? Because the first phase they lose money, the second phase they lose money, and then after that it's just an expansion of margins.
Okay.
And spreading through these industries and becoming the industry standard, right? So when all of the different parts of an industry are using the same, like let's say Microsoft, it's hard to come in with like Google Docs, right? If everybody's using Excel.
Yeah, totally. Although I think Google is actually, I don't know, that's a great metaphor because I used to use only Microsoft.
I feel the same.
And now I only use Google Docs and Google Sheets.
Yeah. And they did that because they made it free.
They made it free, but this is one of the reasons why I think Google's such a great business for the long term.
Yeah.
Is like they replaced Microsoft for all of your software needs for work, and then they did it better than Microsoft did, made it free, but they've got it so that eventually you're going to have to pay.
Yeah.
So people like me, like I have like a side business which is completely reliant on Google. Eventually, Google's going to flip the switch on me someday and be like, okay, now you're going to have to pay us money. You're going to have to lose all this work that you did. And when that happens, I'm going to be ranting to Google because I'm not going to go through hundreds and hundreds of like documents and try and transfer them all over. It's just not worth the effort.
Yeah. And okay, now we're going to pull up the financials and start talking about that a little bit more. So first, when I'm analyzing a high growth company that I'm paying for earnings far in the future, and you consider it like a more speculative or anything like that, what I first want to ask is, what are the chances of this going to zero?
Yeah.
Right.
Totally.
So what is our complete downside risk? So for that, I like to look at the balance sheet. Right. So here
Really
we have over the comparative from December 31st, 2020, we had about just over 2 billion in cash. Now we have about 2.3 billion and change. With a little bit of restricted cash here, we have almost 2.4 billion in cash. With accounts receivable, almost 2.5, 2.6-ish billion, right? And so we've got about let's say 2.5 billion in funds. Now they also have marketable securities. So another way that they're penetrating future markets that aren't fully established is they're investing in startups. So they've got a portfolio of different companies, different startups that they've been investing in. Let me see if I can pull. No. So there's about in like robotics and like all of these like cutting edge, like futuristic, like Kathy Wood type industries, right?
Just two things. I think for the receivables, what you want to see is a higher turnover, right? So we can get that by dividing the average receivables by the sales, and just to see, if we're collecting cash basically relatively quickly. So it does appear that the receivable turnover is slowing down. I don't know why. If they've been expanding their business into the commercial side, I assume they would pay a little bit faster than the government, but maybe not. But it doesn't concern me greatly. I'm just something that I want to mention. And actually, yeah, I lost my train of thought. So the continue.
Okay, so they've got 2.5 billion in cash. So this marketable securities is a bunch of stock that they own in all of these really high growth futuristic plays. So this here could, like, I don't factor into my valuation these companies blowing up. I say, okay, let's mark them all as zero and think of it as like a lottery ticket in the back pocket.
Yeah, makes sense.
Because I think it's like
Oh yeah,
almost
sorry,
almost
I
10
remember my
different
question. What's the reason for them to get in on these startups? Is there a strategic advantage for them rather than buying lottery tickets?
Yeah, so these startups are in industries that are going to be very big in the future, like different robotics and stuff like that. So they want to infect these industries. So the startups that they're investing in are startups that, rather than these startups blowing through their cash to, so Palantir invests in the company and then also gains a customer.
So as we're talking here, I was just trying to do some like back of the napkin calculations. It looks to me like we have 3.2 billion total that we could liquidate, and 0.1 billion or 0.9 billion, sorry, that would have to be paid out in that case.
Yeah.
Which makes me think that, like, considering the market cap's around 22 billion,
yeah,
if the company went belly up, you would lose 90% of your investment, but you would not go to zero. Is that a correct assertion?
Yeah.
Cool.
So also, like Peter Lynch says, a company that has no debt is unlikely to go bankrupt. So this company doesn't have any debt. they paid off all of their debt last quarter.
Oh, okay, that's cool. I didn't realize it. So I had that debt built into my model.
Yeah, well,
today.
most of it's customer deposits and deferred revenue. It's just a matter of time they just put it into their top line. So
Yeah,
I wouldn't consider those as necessarily debts. That's just the accounting treatment.
yeah. So
It's kind of like how we talked about Ford's long-term, short-term debt last time.
Yeah.
Exactly. So they have no debt. I think they randomly bought like $50 million in gold, like physical gold.
Yeah, I don't like that because to me, like it seems like they're putting out a lot of random strategies when they're buying gold.
But but the thing is like the way that I'm feeling the way the AI runs through simulations is they're trying to prepare for every different possible future scenario, right?
What's the market cap on the stocks they own on these venture companies?
Well, a lot of these will be private, right? So it ought to be based on the last funding round.
What's the current
They don't
valuation?
have like up-to-date trades, so you know.
You can see my screen right now, right?
Yeah.
I'm just trying to see like what percentage of their market cap that is that's investment.
Oh, it's 150 million.
Oh, okay, so it's not very much. It almost strikes me as it's almost like weirdly a little bit like a portfolio that's concentrated in one company when they own so many companies and they own gold. But
yeah. So like that's what is like the reason why Google and all of these other big companies, Amazon, is because they own pieces of all of these other companies in all of these other industries that are sort of like hidden under the surface of the main.
Someday one thing pays off like Rivian, right? Then you get like billions in
So the marketable securities is 150 million-ish of what they have.
So I want to come back to this point, Tom. So you're saying like they're basically placing bets on promising startups who they think will become very big. Have you ever heard of like the company talking about, maybe this is kind of like a trial run in a company who's like maybe into the advanced robotics. So then when they try to bring their product to a larger company, they're ready. So they can actually get in and go through the scale phase relatively quickly.
Possibly. Like I haven't dove too far into these startups. I've basically marked them all off as zero.
I think that's the smarter way to do it, to be honest. It's too much work to do due diligence on every single company within a company.
I was trying to understand if there are synergies, right? So with any intangible assets, all the investments are sunk. So that's why you're saying that, hey, 10% if this can be sold, maybe the other 90% will go to zero if the company goes belly up. Well, that's the nature of software businesses, right? So it's sometimes the winner take all, like it's very scalable, but it's also sunk. But the other property is whether they can easily achieve synergies with other parts of the business, and you could consider stakes in these startup private business as potential to achieve synergies.
Yeah. I kind of see this as a potential asynchronistic bet. And I feel like the person buying the stock just has to understand the potential downside and the potential upside.
Exactly.
I was wondering, Tom, if I could make the bear argument on the valuation, and then you obviously know
we're not to the value. We're not to the valuation yet. Let's just.
Oh no. Oh okay.
No, but we're getting close to an hour.
Okay.
Hopefully, Nate. Yeah.
Yeah, I
could stick around, but
a lot of time left.
Yeah.
Yeah. So we've assessed that the company's not going to zero. it has gold. It has almost 2.5 billion in cash, and no debt. Right. So we can all agree that the possibility of it going to zero is very low. So now what we're seeing over here that I'd like to point out is initially when they went public in 2020, they had a lot of stock options that they had assigned people 10 years ago that now we're starting to get vested. So we've seen really large expenses in 2020, which a lot of the bears were pointing out. But what we've seen from 2020 here, the cost of revenue is dropping. Sales and marketing, all of the different operating expenses are declining while the revenues are going up, right? So this brings back everything to when we get to the future parts is the expansion of margins, and that's why I think the valuation is justified. So we
I
have
find it interesting that the basic EPS and the diluted EPS are practically the same. It suggests that there's a lot of if they've been giving out stock options, those are out of the money.
yeah. The stock options I think they were all vested last year, or most of
Well,
them
whether
were.
it's vested or not, that does not affect whether it goes into dilution. So that one I know for sure. So the only thing that determines it is whether it's in the money or out of the money.
Yeah. I didn't see any details on exactly
Yeah.
what the numbers were on that. So we've seen that the losses, over the 6 and 9 months, and the EPS is all steadily improving. They went from last year 94-cent loss to a 5-cent loss. So we can see the revenues going up, the margins are expanding, and yeah. Now,
Speaking of those kind of stats, just as you're scrolling, Tom. So I did my analysis based on Yahoo Finance.
yeah,
And I had a kind of a frustrating experience with that because the numbers that I had on the statistics page didn't match the numbers on the analysis page and didn't match the numbers on the summary page. So you're kind of left there wondering, like, what the fuck are the right numbers? And
so
for
all of
me,
these,
that's
all of
kind
these,
of though, but that's kind of like a bare argument in itself for me, not in the sense that the company's reporting it wrong. It's just the company's obviously in such an early stage in some senses that like we're having a hard time finding third-party data information about the company.
Well,
so I
Ticker
find all kinds of data issues with Yahoo and different companies. All of the data here is pulled directly from the financial statements.
That's fair. I'm sure your data is better than mine because I just based mine off Yahoo Finance.
Yeah, I go to the investor relations page and I download the actual quarterly reports that was filed with the SEC.
Sure.
So yeah, like, anyway, with companies that with less than 5 years of financials, yeah, it's not such a big deal, right?
So we can see projections for full year 2021. They're about to report the quarter, I think, in a week or two. Full year is expected to come out at 1.527 billion with an adjusted free cash flow of above 400 million.
Cool. Are they going to be profitable as of the end of this quarter?
They haven't really talked about like net income profitability, but more of free cash flow as a metric.
So the reason I ask is just because the summary page on the Yahoo Finance has them running a net loss, and the statistics page has them running at a net profit. And I'm just curious to which one's correct. Are they running a profit or not running a profit?
Their net income is negative. So they had the last quarter, it was a 5-cent per share loss on adjusted basis, but they had a positive free cash flow of, I think, 120 million or something for the quarter. Or so adjusted free cash flow.
Adjusted, yeah. So because
they took out stock-based compensation.
Well, cash flow obviously excludes stock-based compensation.
Yeah.
So the adjustment to the cash flow, I wonder if
are non-recurring items
for the investment in marketable securities, because those
that's
those don't matter as much, right?
And
they have very little capital expenditures. I mean, it's a software company. That makes sense.
Yeah. So their adjusted free cash flow margin for the past 2 quarters is around 29-30%.
Cash paid to employer payroll taxes on stock-based. Yeah. So they can't avoid those. Yeah.
Yeah.
Okay. So that is the big.
So this is full year for this year. So now in terms of valuation, this is because we were just looking and talking about free cash flow. We're gonna talk about free cash flow in terms of the valuation. So this here is a chart of Microsoft, Google, and Facebook's free cash flow to market cap. Okay. So
that makes sense.
So because we can expect future margins to probably be in the same ranges, maybe. So I think that's a fair comparison.
Yeah.
So we've got here, if we look, I'm looking for the range here, right? So we got 25, let's say 25 times on the bottom half and like 40 times on the top. So we've got in between 25 to 40 times free cash flow to market cap. Okay. So now this is how I usually like to look at growth companies is I want to project. So what this chart here is, it's a projection of revenue. So what I did is I took revenue growth of 25 to 40% and free cash flow margins of 30 to 50%. So what it does is 25% is below guidance. So if you look at the different lines, like each line is like let's say the bottom line here is like 25% revenue growth with 30% free cash flow. And it does a combination of everything to give me a range. So the bottom line would be if they got 25% revenue growth and 30% free cash flow margins. The top line in the top of the range would be like if they had 40% revenue growth and 50% free cash flow.
Yeah, you have a matrix of all the outcomes.
Yeah, so this is like all of the potential it's like all of the potential outcomes that I see as a probability to give me.
So what do you put as the most likely and what do you put as the bear and the bull?
That's going to be next. Yeah.
Oh, my apologies.
So I think, so this is just to give me a range. So that means that by 2025, we're going to have, according to this, in between 1.98 billion to 2.88 billion in free cash flow. And by 2030, 3.35 to 15.5 billion in free cash flow. It's good because it's really hard to project. Like no analyst can accurately project. I don't like looking at, so I want to give a nice range. It's going to be a larger range, and then I want to look at the worst case scenario of the bearish of the bottom line and the top line of the range. So I
did the exact same thing for my evaluation.
Yeah. So if we looked at when we were on this one here, we said 25 to 40 times would be an appropriate valuation. Now, fair multiple, I lowered the range to 35. Let's just throw the top of the free cash flow. So a fair multiple would be anywhere from 25 to 35 times free cash flow. So if we had 1.9, these are the ranges that from the first chart. So that would mean that using these multiples would give us a market cap in 2025 of 49 billion to 100 billion. Currently, I think the market cap's like 25 billion-ish or something like that.
Yeah.
So that would give me if they missed all of their guidance and only were able to hit 25% growth, with a free cash flow with the lower end of the free cash flow market, you'd get a 15.95% CAGR up to 34.36% CAGR over the next 5 years. Right. So that puts it like I try to aim for like around 20-25% a year. So that puts it close to I'm looking at like a worst case scenario.
My worst case scenario is actually the same. I put 25% as their worst case.
Yeah. So I put as the worst case scenario over the next till 2025 is 15.9 is a 16% CAGR as my worst case scenario. On the to 2030, the 3.35 to 15.5 billion would give us a market cap of 83.75 billion up to a maximum of 5.4 billion. I mean 542 billion, which would give us a CAGR of 14.71 up to 38.57. So I think over the next 10 years, I think it's reasonable to, like my projections, I think that this is like a fair range of where the possibility of outcomes. I tend to lean that this is going to be a lot more to the higher range, like what the company's actually going to do, and that these might be conservative.
I actually, my projections are really similar to yours. Although I think that's a little on the bearish side. I actually don't think it's the valuation is worth it now if we have that sort of bearish argument.
If you have what bear?
So if I could, can I share my screen real quick? Or
yeah,
sweet. Oh, okay. I'm just gonna. Oh shoot! I'm so not used to doing this. Is there a share entire screen thing?
Yeah, it's gonna be the button in the. You have to put your probably screen over the menu. Oh, there you go.
Okay, sweet. Oh, 1 second. It's blocking my tabs. There we go. How do I get this out of my way? Okay, here we go. So I got their current PE is sitting at 3.39, or sorry, 339 according to Yahoo Finance. Although it depends where you look. At some parts it says it's in the negatives, and one part it says it's 339. So I'm not sure how they're calculating that. But I did everything based off the idea that it's currently trading at 330 times earnings, which obviously that's a very high price for any company. And this is, I mean, really, realistically, I'm looking at this like a venture stock. I'm thinking this is a company that is in its early infancy stages. And I think you got to look at it in terms of what is the maximum potential, what is the worst case scenario. So I see worst case scenario, as you pointed out, if the company basically can't compete with its competitors like Google. And it drops by 90% value. And then the other hand, I think looking at a more bear side, or sorry, I think the more average side would just be looking at past growth. I love looking at past growth because I think it's not always going to be accurate, but I think it's a reasonable prediction. And sometimes I think it can be a better prediction than analysts, because I think analysts tend to sometimes be wildly bullish.
Or wildly bearish.
Or wildly bearish, right? So I think just, saying what's the future growth look like might look like past. So I just looked at the last 3 years because that's the only years we have growth on record. We had 2019, they had 20% growth. 2020 had 33% growth. 2021, they had 24% growth. I just took it as an average 25% growth.
Where did you get these numbers from? Those are not correct.
What is growing?
Off of Yahoo Finance.
Oh, here, so go on your screen right now.
Talking about margins, or are we talking about sales?
I'm talking about revenue growth.
Oh,
yeah, those numbers aren't correct.
I can
go pull up the investor relations page and pull up the financials.
Yeah, Nate.
They're growing above 40% already this year.
Yeah, I can.
What do you guys
I'm
have
looking at Ticker Terminal.
Pardon?
And I pay for this service, and it's about 40% every year.
40%.
I mean, every quarter, yeah. So year on year for every quarter, it's like 42%.
Here, I'll share my.
So
I have
the analysts, because I can just pull it up based off the analyst line, because the analyst growth, average analyst ranking according to Yahoo Finance is 40% basically. So I did do an evaluation based on for it. So if we do an analyst ranking based off of
Q3 highlights, I'm looking at their financials right now. Q3 2021, the last quarter, they reported total revenue growth of 36%. So from Q1 to Q3, so the year to date, they're about to report total revenue growth of 44%.
Okay, so I'll just look through basically based on that 40.
And their guidance is they've guided at 30% or more for the next 5 years.
Okay, that makes sense. Okay, well, I won't bother trying to redo my calculations while we do the video, but I'll just go through the analyst growth one, because what I have is the analyst growth was at 40% per year. So first off, we get a PEG of 2.94. This is kind of not something that's attractive to me, actually. Generally speaking, as an investor myself, I try to look for companies that have both high growth and fair current valuations. And just generally speaking, to be honest, the whole fact that they're not currently making a profit is just it's a no-go for me. As a rule, I don't go invest in non-profitable companies. And I think you can make a lot of money investing in companies pre-profit. Absolutely you can. And I'm not saying you can't. I just think your risk profile goes up. I see it as a risk reduction strategy. I only invest in profitable companies. And the only time I've broken that rule, I lost money. So I'm not in an eager state to try that again, personally. And then when we look at just for the viewer, usually a good PEG is considered below 1. And
where are you getting these numbers from?
So PEG, again, that was just based off the Yahoo Finance. So they had it set it as 5-year PEG is 2.94.
Oh, okay. Yeah, I tend to ignore analysts completely.
Yeah. But but that's based on pretty high growth projections, right? So even if we have a really high growth rate for the company, we still don't get a very attractive PEG because the market cap is already pretty high. I mean, I think that's obvious because there's obviously a lot of people who are quite bullish like you, who are obviously already pricing in quite a bit of growth into the company.
Yeah.
So I think we have to have a higher return to make it so. If we get 40% growth over the next 10 years, we'd end up with like a PE at 3.41 based on those calculations, which I think that's a steal. Like if that growth actually happens, like you'll make a crazy return on this company, and I think it'll be good. But I think the real question is expecting them to grow at 40% every year for the next 10 years straight. Like that's a pretty tall order. That's a like high magnitude of thinking. So if they only grow at 25% per year, they're gonna end up with a PE of 25 in 10 years.
I'm kind of confused. So you're projecting 10 years out.
Yeah.
We don't know the price. So how are you gonna get the PE ratio?
So I'm basing it off of if the price didn't change. So that's something
if the price does not change. Okay.
Yeah,
Okay,
like,
you're
what if
basing it on today's share price.
Today's share price, and if profits go up at this rate, what would it be? So because I'm trying to think of the value at a future rate or a future time.
Yeah.
So so I'm just thinking like even if the profits went up this much or went up 25% over the next 10 years, we get to a PE of 25. Okay. And that's not terrible. Like I actually think like that looks like a company that like it intrigues me. So like I tend to do this type of analysis on a lot of companies. There's a lot of companies I look at where I think I get a better metric, where I get a much lower PEG and I get a much lower PE in 10 years.
So hold on, they're expecting growth of the PE by 25%? Like
no growth of earnings. So like this
growth of earnings. Oh,
so I'm saying if earnings went up by 25% over the next 10 years, every year, and the price and the market cap didn't change, the PE would be 25.
I'd say that's low, right?
I think that's way too, like I'm projecting probably like 50 to 100% profit growth. Like if we're looking at like net income over the next 10 years.
Yeah, if they have any type of leverage, operating leverage,
because there's going to be margin
sales
expansion.
Goes up by 30
right?
to 40, you're expecting the earnings to at least go up by 80 to like almost 100%.
Yeah. Like even if
and also the PE, I read like from the most recent quarter, it's like price to normalize the PE is only at 97. So again, like if we're going off Yahoo Finance numbers, our inferences can be completely off. Not to say your reasoning is off, Nate, but like some of these numbers.
I only look at Yahoo Finance.
Yeah, I hate looking at the Yahoo I find so many mistakes all the time on all the different companies. I always go like to the SEC filings. Whenever I want to look at anything for any I want to see what's on the SEC filings.
Yeah.
Because I've even because before when I was a couple years ago, like I was looking at different sites and they had different numbers.
Yeah. No, I get that. Like I said, the reported numbers on the analyst page, on the statistics page, and on the summary page didn't match.
Yeah.
And even like the forward PE they have as 69, I believe, when that's for next year. That didn't match the growth either. So I did like a what happens if they get that kind of growth? And we're talking like if they got enough growth to get to a PE from 300 to 69 next year. Like where you're talking about explosive growth for the company and like everybody should buy it all now. But
that's what I'm doing. Like because
that's your mindset.
Yeah.
So I'm just thinking like I think we have seen similar growth for the last couple of years from Google, and I think Google's compared to like its earnings now, I think it's like a much cheaper valuation. So when I look at this company, I see it as like a direct competitor of Google, and I see Google as having a better moat. And cheaper evaluation.
Actually, getting back to some of the point you made earlier, Nate, about this, what is the ethical perspective of the investing? I mean, I heard Alex Karp says that like these Silicon Valley companies won't help the government, and they take a decisively different stance, right? So we're gonna help the government, U.S. government. So to that extent, I don't think Google will ever try to compete with Palantir on the government contract front.
No, you're probably right. but like on the commercial side, like I feel like Palantir is going to have to compete with Google
I
in
think
the
I,
future.
I think that there is a good possibility that that might happen someday, and that's why I think Palantir needs to become deep rooted in different industries, right? So they've launched platforms for crypto. I'm trying to remember the compliance, right? So like think of like the blockchain and how everything is public data. That's thousands of different blockchains of where money's being transferred, right? And to be able to take all those different data points and understand what's actually going on in terms of compliance for crypto
Yeah.
brokerages.
I actually don't understand, how so if in an enterprise business, and right now the blockchains, we're talking about public blockchains, how does that even, like why would anyone pay for that service? Are we talking about the exchanges that would pay
It's
Palantir for this?
it's because the data that the way the data is interpreted, right? Like the AI that they have in their system can understand what this data is and where it actually what it actually means, right? So a lot of these crypto brokerages with all these government regulations that come in, and even they've done it for the banks already in terms of compliance. We need to know who people are, where they're sending their money and stuff like that,
Yeah.
to make sure that people aren't using drug money and laundering money and stuff like
Right.
that through these crypto brokerages. Because if you're a crypto brokerage and all of a sudden a newspaper article comes out that you're laundering money for people, your business is going to suffer. The government's going to start sniffing around. So you don't want to hire developers to develop this AI technology. You'd rather just have it deployed, and that you're compliant with all the government regulations, and you don't have to worry about it.
That makes sense.
So who's Palantir has listed as their biggest competitor, right? Isn't Google. And I think the biggest competitor for Palantir are the businesses themselves trying to build in-house solutions with their own developers, right? So like, why is Tesla going to hire Palantir when they have all of their own developers interpreting the data from autopilot, right?
Well, Tesla already has their own. So
Yeah. So the biggest competitors that Palantir lists are the in-house developers, right?
So I guess like my question to you, I would let me see if you think this is a fair characterization. I think this is an asynchronistic bet, and that the potential return is a lot higher than the potential loss, because the potential loss is 90% loss, but we're obviously talking over a 20-year time period of like a really high exponential growth.
Yeah.
But I see the risk in that if they do a poor job executing, they're not going to get the high growth rate that justifies the current market cap. And I see that a lot of the growth is priced in. And then we're also looking at a company that currently has negative profits. So I see this as like, you are risking money, not just on a potential loss, but you're also risking money that if the company can't execute to expectations, that you're not going to make a return that justifies holding them for the long term. And I mean, of course, that applies to any stock, but I think when we have higher growth rates expected and a higher market cap compared to the current growth rate, I think you have to price in the fact that there is more risk because there's more requirement of execution.
Yeah. And one thing that so I've seen different YouTubers talk about Palantir and stuff like that. And one thing that I'm surprised that they haven't, I haven't seen anybody bring this up, is the fact that if you believe that Palantir's software can do what it does in terms of like predictive running simulations on predicting outcomes, right? They're using it themselves in their own business.
Yeah.
So if you believe that this, it's all of, if you believe how, understand how powerful this software is, and that like what Peter Thiel said in his book about Palantir is 0 to 1 is not duplicating what other people have already done and trying to make it better. It's starting from something that doesn't exist and creating it, and then to be a real competitor against Google and stuff and all these legacy ones. When you create that new product, he says it doesn't have to be just incrementally different. It has to be 10 times better, right?
Yeah, I think, but the good question, the reason I come back to it is, people don't really talk about Google as an AI company, I don't find. But I think it is like you look at Waymo, they're really quietly doing some research. Like last year, they put out a report because they built a new supercomputer and it was the fastest computer ever built. And if you read the report of like the goal of the things they were talking about using that technology for, it was like some weird utopian like future they were talking about. They were talking about using the AI to develop drugs rather than having like pharmaceutical companies like Pfizer develop drugs with people doing experiments. Just have the computer run like data through its artificial intelligence to create future drugs, to have it create future softwares for them so they don't have to create their own software. Like when we get to like once we get to a certain level of AI technology, it's going to be exponential growth in technology. So like I think there is a huge future potential here. But
so Palantir is also doing that with biotech.
Yeah.
I think the big difference is Palantir is more on the edge, right? Like I'm not talking about like having an edge, but like edge computing. So it's about like having Google is going to centralize. They try to centralize the processing power and the data, and then we'll try to use that, with the AlphaFold and stuff for developing drugs. But Palantir is more like, well, we're not going to centralize it, right? Your data belongs to you, and our platform allows you to better utilize it, right? And so you can look at Tesla. They have their Dojo, neural net training computers. Like anyone who wants to train their own neural net can use our computer. So you can see all these different kind of ways companies try to leverage their expertise. And I see like Google and Palantir to have very different approaches. And the question is, which one are more likely to be accepted by these commercial clients?
And I think you gotta consider brand recognition in that too.
And so one thing that I have to say, like a little bit on the bearish side of Palantir versus Google, that Google has working against them, is the idea that Google uses everyone's data. So Palantir does not use your data. They don't take your data and store it on their your data is your data, and it's private and protected at a level that is good enough for the top secret service, like classified documents of the US government. So I think that the other thing is that the way this software becomes integrated into the business is the cost of switching is extremely high, right? So
stickiness.
It's extremely sticky. Once they get in there and all of the employees are using it and it's a part of the business, it's almost impossible to get out.
One bullish thing I'll say about Palantir in competing with Google is that as much as I think Google is a future competitor here, I don't think Google has any products that are similar to what you're describing for Palantir currently. So if they do end up trying to compete with Palantir, they have to create a product essentially from scratch.
Yeah. I'm sorry for.
Yeah. So they have to create. Oh, sorry. Yeah.
Yeah. Sorry for interjecting. So I just want to. I think Ticker Terminal has better data aggregation than Yahoo Finance for sure, since I pay for the service. Now on the issue of like growth, right? We're talking about Peter Lynch. How fast is earnings growing? If you look at growth, if you look at operating income, right? So yes, they are negative, but the year and change, we're talking about. Okay. Actually, no, it should be gross margins, right? So the year-on-year change, we're at 49%. Well, these are is their quarter. So
and also
63%, 62%, 118%. If you calculate your PEG on those growth rates, the valuation does not seem as outrageous, right?
So while you're talking, I'm going to see if I can calculate a PEG based on that real quick.
And also while you're calculating
leave that up?
I want to point out.
Oh, you want to leave it up? Okay.
Yeah, just so I can calculate a PEG.
So I want to.
Sure.
Oh, I can't even see what you have up. Oh.
Yeah, because
so I'm looking at also in terms of profitability. So the net loss for the previous quarter was $102 million, right? Now, one thing I like to do is take away research and development from this. So like if they weren't spending on research and development, which is like sort of something they choose to spend on, right? They would be profitable.
It'd be close.
Or they would be pretty close to break even without R&D.
Yeah. Well, also selling and selling general admin expense. I mean, just forget the stock compensation for a bit. The selling expense for any fast growing company when they're taking on a lot of clients, that's going to be a huge number, right? So what matters is how long are they keeping that customer, right? Goes back to the question of churn. But if they're keeping the customer for 20 years, they get to leverage that selling expense for forever. So yeah, it's a matter of right now seeing past all the upfront expenditures they have, and you realize that this company has some pretty big leverage. I think, like in terms of operating leverage, that would leads to triple-digit growth in earnings, I think.
I will say, so the PEG I got before was just the PEG calculated by Yahoo Finance. The
Yeah.
PEG I just manually calculated was worse.
Oh yeah.
Yeah.
But like it all depends on. See, the thing is, PEG is like analysts' expectations.
Yeah. So I just based that on the expectations of what was the average growth rate here. So I think I got a 66% growth rate on average looking at these years. And admittedly, that the quarter in 2020 that's 48% is a bit of an outlier, but 66% growth rate is pretty high growth rate. Now, what do we have as the actual PE here? To be fair, because I was basing it on the.
Oh yeah, let me pull it up for you. So the PE.
Is this trailing or forward?
Let's use trailing.
Well, these are just these are the past financials. Go to valuations, you can see. So they had both trailing and forward. So you can see the price to normalized earnings.
Okay.
Yeah. So
okay. So this must be what they're, because the 333 it looks like it's based on that 334 market cap to free cash flow thing. So that must be, so let's look at normalized earnings.
Yeah.
So 148 divided by 66. Okay, we get a PEG of 2.24. So that is how that's exactly the same number.
Yeah, I was like,
so that's how Yahoo Finance calculated it.
Okay.
So, but again, so that PEG still isn't attractive. Not now. I will say one thing against using the PEG.
But that was March 2021. I mean, shouldn't you at least look at December 2021?
Oh, sorry, I'm looking at the wrong side of the chart, am I?
Yeah, yeah. So to go to the right, it's more
okay,
recent.
I see that.
Yeah.
So 60. Oh, okay, 68 divided by. Oh yeah, we get a pretty fair PEG then. We get 1.03. So that is, I would say, fair.
Okay. And
it's not as good as Google or Facebook's, but it's a fair.
Yeah. Yeah. So hopefully this company grows faster than Google, right? Otherwise, Tom sees his shot.
Yeah.
To be fair, I'm pretty sure Tom owns Google too.
I do. Yeah. Yeah.
Well, we all
my
kind of balance.
Yeah. Everybody except so we viewers watch this. We have a group of people who talk about this, and everybody except Tom owns Google.
No, I own Google.
Do we all own
Google?
I own
no,
Google.
Tom doesn't, or not. Sorry, not Tom. Jake.
Yeah.
Oh, Jake.
And he bought Facebook right before a big drop too.
So did I.
We talked up Facebook, and then it dropped further.
Yeah, but like I haven't been buying Google because I think I have an average cost of like 1,700 or something like that. I bought it last year, I think.
My average cost is higher than yours, but it's still pretty low. Mine's 24. I've stopped buying Google too. I actually think personally Google's back in a buy position. It's just my personal opinion. And by the way, I'm not a qualified stock investor. I'm a school teacher. If anyone has financial advice for me,
so let's just ask Tom this question, right? If Palantir price drop from this point, let's say another 25%, would you sell Google to buy more Palantir?
I think he would.
I probably wouldn't sell Google to buy more Palantir, but I would just be putting as much of my income into it as I could. Or like I have some like I don't think I would sell Palantir. I mean, I don't think I would sell Google, but I might sell something. Like if Palantir went down to the 5s or something. And then also I'm trying to limit my position. So like right now I've got I think about 2,100 shares of Palantir.
Right.
like 2000, around 2,100 shares I've accumulated so far. And
Right.
if it keeps staying down,
Yeah.
I'll keep buying it.
What's
'Cause-
your so for this is obviously a more, I mean, okay, so any kind of like once anything you did deep dive on, I wouldn't say speculative, but this is not your biggest position, right? So what would be your kind of like strategy going forward?
Oh, I'll comfortably make this my biggest position. It's pushing in the top two. I think I've got this equally weighted with Google right now.
I see.
And but like I try to like keep it down to like I don't like anything getting too big. No matter how bullish I am on it. Like no matter how confident I am, I don't want it to get like 30% of my portfolio or something. Like that's too like I like to make it so that if this goes to zero or if it goes down, it's not gonna kill my returns, right?
Yeah, I think that's smart, right? Because it is for if the company is not yet gap earnings positive, it's always smart to limit your position size.
Even if it is gap positive, like look what just happened with Facebook, right?
Yeah.
Like
Yeah.
regardless of whether it's profitable or not, like having too much of your money on one company, I think is very dangerous.
Yeah, I've seen a lot of stock pickers recently say like they believe in only owning 5 or 6 companies. I don't agree with that. I try to keep it around 20. I have a hard time keeping it below 20 because there's a lot of companies I track and I like.
I try to keep it around like 15.
Yeah, I made my best ever return in a year where I had like 5 stocks. That was my first year ever investing, and I also bought at the bottom of March 2020.
But
so
like-
I don't think I'm gonna have that kind of return ever again, to be honest.
But see what
yeah.
when like my suggestion always when you're starting out is to have a very concentrated portfolio. So like let's say if you're funding something off of your income, like the way I buy stocks is I'm not buying 20 different stocks at any given time. What usually happens is I'll find a stock and I will buy that one stock or two. Sometimes I have 2 or 3 different stocks that I'm going to be buying, and I will just put more money in and put more money in and build out a larger position, and then
That's exactly what I would do.
and then let it sit there. So like if I was starting a brand new portfolio, I might only have 1 or 2 stocks and just keep putting my money into those 1 or 2 stocks, and then eventually when those get to a fairly like a dollar amount, like $10,000-$20,000 or something like that, then I would buy a 3rd stock and just keep adding different stocks to the portfolio. And then the stocks that I bought last year, right? Because usually like I usually like to like catch falling knives and buy stuff on the way down. So when I'm buying on the way down, the companies that I bought, it skews the portfolio because I'm buying and it's going down, and I'm buying and it's going down. But then usually what happens is in the next year or next 2 years, that's when that company takes off. Like some of my best returns, I've been down 20, 30, 40% on for like 6 to 8 months, and then all of a sudden it doubles or triples in a matter of like weeks.
Yeah, that's my exact strategy too.
Yeah,
For the most part, I try and catch falling knives, and I build one position at a time. I don't
think the idea of having a diversified portfolio, it's a little bit misconstrued, right? Like if your stock portfolio is as big as your home equity, then yes, you want to diversify. But like you said, if you're just starting out and your stock portfolio is tiny, you probably, your car is probably worth more than your stock portfolio. At that point, does it really matter if your stock go to zero, right? Like any single investment could, but as your stock portfolio becomes bigger and bigger, and then certainly that's the time to think about more diversified approach. So I mean, I was never a single stock investor until 2019, and so I didn't have that problem. I just put money in the index funds. But I've transitioned to more of a single stocks. But at that point, it's already a sizable portfolio. So I chose to go with 25 to 30 stocks actually.
Yeah, like
I was actually
for me that's too much to track.
I was buying index funds originally, and I firmly believe most people should not be stock pickers.
No,
most people should just buy index funds. And I feel like you and I, we all participate on forums for stock picking. And honestly, I look at the posts of 95% of people, and I think you should be just buying an S&P 500 index fund of some kind. But like, that being said, when the S&P got up to like an earnings to price ratio of 44, I was like, that doesn't make any sense. Sold it all and started stock picking. And like ever since, I've been beating like the index. So like it's kept me like going. But if I had like a period of time where I started to really underperform, I'd probably really start to rethink my strategy.
Yeah.
And I think there's a flaw in that thinking, obviously, in that because I do execute a similar strategy to Tom, but I do a lot of catching falling knives. So it makes sense that I might have a year where I underperform. But if I had two or several underperformed, I don't think I could hold that. I think I would just start buying indexes again.
Yeah, actually, I know someone who stock picking was his hobby and he has a sizable portfolio. But I think in 2020, 2021, when the valuation got extremely weird, he actually did the reverse. He said, screw it. It's hard for me to use what I know in the past to value stocks. Everything seems out of whack, but I still want to be invested. So he went indexes. So, you know, you could have all sorts of investment thesis, and it's interesting and tough game. So I don't want to keep dragging this out. I think Nate.
Well, we got to hear your. I think we got sort of devolved the conversation. That's probably my fault. We haven't heard your final position on Palantir. So like obviously Tom is super bullish. I'm a little on the skeptical side, so I'm staying out of Palantir. What's your position on Palantir?
So, I have a confession to make. I didn't really, you know, my biggest position is Tesla. You guys know this, but I didn't really start investing in Tesla until 2020 when they were pretty sure to be, you know, they have survived all the past travails and are gap positive. And certainly I wasn't, you know, I didn't get the 10x, right? So my current thinking of Palantir is still the same, is I'm waiting for some signs of profitability. It's like, yes, I will miss out on probably the biggest gains, but like if this is the company that worth holding, you know, it's what Buffett said, like it's better to hold a great company at a fair price as opposed to a good company at a great price. So I'm waiting for that moment. I mean, but you know, this talk kind of solve some of my concerns around, you know, what's the competitive position of Palantir and whether they like to maintain it. So I'm slightly more bullish. I don't have any position in it. I think I'm still waiting for at least a few quarters of data to inform my decision.
Yeah, I kind of fully agree with that. I like Tom is super passionate, and I actually kind of trust him in that, knowing that his into qualitative analysis, that Palantir's probably going to do well in the future if Tom puts his like stamp of approval on it. Not that I'm telling everyone go and buy Palantir, because I'm not.
Yeah,
but
don't go out and buy Palantir because we're.
But at the same time, like for me, there's just too much risk, and the valuation compared to the risk is too high. So I'm staying out. But if I start to see like positive earnings growth and real profitability, as kind of says, I'll do the exact same thing. I'll probably buy some.
Yeah, like I want to bring up, like, I think it was Peter Lynch who said, you know, I can't remember the exact quote, but he's like, yeah, if you would have bought Walmart at its IPO, you would have made like 100x your money or something. Or if you would have waited like 10 years to buy it before they became more established, you still would have did like a 25x or something like that.
Yeah. And that's more my strategy is trying to find really good companies with really good moats that are experiencing a short-term blip in their stock price. And then I try to buy in on that blip. And then, to be honest, I probably have the different strategy of, I often try and get out when I think they reach over fair value, which I think happens probably more than people realize. So I do a lot of swing trading, which is the worst thing you could probably do if most people asked you.
Yeah, I used to do that, and I found what would happen is I would sell at all the wrong times and leave so much money on the table.
Yeah, well, what I always do, to be fair, is I never sell the entire amount. I always sell profits. So
yeah,
if I think a company is like worth more than or is trading above fair value, I sell my profits. But that being said, and then I take that money and I go buy a new company that I don't own.
Yeah,
that makes sense. Like,
okay, so which
but yeah, I use call options in a similar way. Is
yeah,
when I feel a company's getting like, oh my god, this is a nice run, I'll sell some out of the money call options.
Yeah.
That's hard for me because I don't think I have enough money to use call options. I went to do it a few times, and then I was like, oh yeah, I can't sell call options on Google. I'm not anywhere near rich enough.
No, but like even
But they will. You will if you have at least 5 shares. They'll
like
you have 100 shares. But you know, I just want to see where this is conversation is going. Next week, Nate, do you have a company that you would like to
I'd love to either look at Pfizer or Facebook.
Facebook? Okay. Yeah, Pfizer and Facebook are all sounds good. I hope that you give us an indication.
I think like yeah,
a
let's
few
do
days
Facebook.
before so we can look into it.
Facebook.
Yeah, let's do Facebook then. I think
All
I
right.
think everybody in our group owns Facebook, so we might as well
Yeah.
do one where everybody owns it. Everybody's at least a little bullish.